For more on this, CCTV's Owen Fairclough spoke to Jacob Kierkegaard. He's the senior fellow at the Peterson Institute for International Economics.
I think the reality that you cut interest rates by another 10 basis points, which is 0.1%, really for the man on the street isn't going to matter very much, because for all respective purposes, interest rates in Europe were zero yesterday, and today they're just a little bit closer to zero. But rather, it matters quite a lot for financial markets, because Mario Draghi was very explicit today in saying that this is it. The ECB is under no circumstances going to cut interest rate further. So if you, the banks or the financial actors in Europe, want to have money as cheap as they can ever become from the European Central Bank, now is the time to take these loans with the ECB.
Do you think that's going to work? Because we've seen these rate cuts happening. The data we get is that banks still aren't really lending in the way that most Eurozone countries would like them to. Is there any suggestion that this latest move will actually work?
Well, no, there's no guarantee that it will work. But I would, however, on the other hand, say that with this latest move, the ECB has done everything it can to address any supply-side constraints, that there really shouldn't be, if there are banks in Europe that have potential viable candidates for a loan, that bank can now get that loan financed by the ECB. That doesn't, of course, mean that there is a huge pent-up demand for more credit in Europe, because growth is as low as it is. But at least on the supply side, which really is the ECB's principal responsibility, I think it's fair to say that today's measures should solve those issues.
How much does it matter that we're seeing central banks around the world starting to move out of step with each other? The European Central Bank is going further down with its rates. The Bank of England has said it wants to move rates up. The Federal Reserve here in the US is going to follow at some point.
Oh, I think it matters quite a lot. Because one of the striking things, of course, was that in 2008 we had this globally synchronized downturn that basically forced every major central bank to, for the first time, in fact, be very coordinated in their actions. What we're seeing now is essentially sort of a return to normal, where the business cycles in the UK or in the US are very different than they are in Europe. But I actually think that's probably a good thing by and large. It will have, I think, potentially substantial implications for global exchange rates, where I, for instance, would imagine that as the Federal Reserve begins to raise interest rates, or the Bank of England begins to raise interest rates, but the European Central Bank keeps interest rates at zero, that should put upward pressure on the US dollar and the British pound vis-a-vis the euro. And I think a lot of that resilience, if you like, or calm in global financial markets is due to the fact that as the Federal Reserve has pulled back its stimulus, the ECB has been dialing up its monetary easing, so that they sort of essentially cancel each other out. And therefore, I don't think we should at all be afraid that large global central banks begin to act out of sync